Imagine a world without money. To buy your morning coffee, you'd have to trade something you own, maybe a loaf of bread. But what if the coffee shop owner doesn't want bread? You'd need to find someone who does, trade with them, and then return to the coffee shop. This is barter, a system where every transaction requires a perfect match of needs. The problem? It's slow, inefficient, and makes even simple trades difficult. There's no standard value. How many loaves for a pair of shoes? And what if you want just a handful of grain but only have a cow? Many goods spoil or can't be divided, making it impossible to save or spend wealth easily. Barter works in tiny communities, but it's a huge obstacle for growing societies. People needed something everyone agreed was valuable, portable, and easy to divide. Over centuries, this need led to the invention of money, a tool to make trade simple, fair, and efficient. Money became the solution to the chaos of barter. It changed everything. Before coins or bills, ancient societies used commodity money, objects with value, like cowrie shells, salt, or grain. Cowrie shells, prized for their rarity and beauty, became currency across Africa and Asia. In Rome, soldiers were paid in salt, so valuable it gave us the word salary. Cattle, grain, and other essentials also served as money, rooted in daily life and survival. Commodity money solved barter's biggest problem. Everyone accepted it, knowing it could be traded again. This made trade smoother and allowed people to specialize in their work, but these items had flaws. Their value could change, they were bulky and hard to transport. A bumper crop could make grain money worthless, or a new shell discovery could cause inflation. As trade expanded, people needed something more durable, portable, and stable. The answer: metal, ushering in the next revolution in money. The stage was set for coins. Precious metals like gold and silver became the new standard for money. They were rare, durable, and easy to divide, perfect for trade. For centuries, people weighed and tested metal for every transaction, but this was slow and open to fraud. Around the 7th century BCE, the Kingdom of Lydia introduced a breakthrough pre-weighed metal pieces stamped with an official seal. These were the world's first coins, guaranteed in weight and purity. Coins made trade faster and more reliable. No more scales or purity tests, just count the coins. Governments used coins to spread their image and control the money supply, linking money to state power. Coins spread rapidly, fueling markets, empires, and economic growth. They became not just tools for trade, but symbols of authority. The invention of coinage transformed economies and societies. It was a leap forward from barter and commodity money. Coins made commerce possible on a scale never seen before. The connection between money and power was forged, and it endures to this day. As trade grew, even coins became impractical for large or distant transactions. In Tang Dynasty China, merchants left coins with agents and received paper receipts, early banknotes. These flying money receipts could be traded like coins, backed by trust in the issuer. The Song Dynasty made paper money official, creating the first government-backed currency. The value now came from a promise, not the material itself. Fiat money was born. The idea spread slowly west, but by the 1600s, London goldsmiths issued receipts for deposited gold. People soon traded these receipts instead of the gold itself. Modern banknotes had arrived. Banks realized they could issue more notes than gold held, creating new money and expanding credit. This fueled economic growth, but also risked bank runs if trust failed. Paper money made trade easier, but required faith in the system. The world was moving from metal to promises. The rise of paper money and banks changed everything. Banks pooled savings, funded businesses, and powered economic expansion. Central banks like the Bank of England unified national currencies and stabilized economies. They managed money supply and interest rates, shaping entire nations. International trade flourished with bills of exchange, paper orders to pay across borders. The gold standard anchored currencies to gold, providing global stability. Banks became the heart of the economy, pumping credit and capital worldwide. Money was now a system of trust, not just metal or paper. In the 20th century, money began to disappear from our hands and move into the digital world. Credit cards let people buy now, pay later, no cash needed. Electronic funds transfers and ATMs made banking faster and more convenient. The internet brought online banking, e-commerce, and digital payment systems like PayPal. Money became data, numbers on a screen, not coins in a pocket. Commerce sped up and went global, but new risks emerged: cybercrime, data theft, and privacy concerns. Every transaction left a digital trail. The meaning of money shifted. It was now information, not just a physical thing. Our relationship with money became more abstract than ever. The digital age had arrived. In 2009, Bitcoin launched a new era: digital money without banks or governments. Powered by blockchain, Bitcoin was decentralized, transparent, and global. Supporters saw it as financial freedom. Critics worried about volatility and misuse. Cryptocurrencies sparked debate and innovation, forcing central banks to consider their own digital currencies. Mobile payments turned smartphones into wallets, making cash almost obsolete. Money's story is one of constant reinvention, solving problems, building trust, and connecting people. Today, the line between money, data, and technology is vanishing. We're living through another transformation, with the next chapter being written now. The future of money is uncertain, but its evolution continues. The story isn't over, it's just beginning. If you enjoyed exploring the evolution of money with us, don't forget to like, subscribe, and share this video. Join us as we uncover more stories shaping our world. Thanks for watching.